Let's continue with other measures. One is leverage. So what is leverage? Leverage is all about the capital structure of the company. It's about debt. So it goes back to our income statement part and shareholder-debt-holder relationship, basically. If you remember, in good times, if company generates lots of income, since debt holders get back a fixed portion, interest portion, all the additional money goes to shareholders. So debt or leverage, you can think leverage as debt, it makes good times better for shareholders. In bad times, the company will be in trouble and the company will not be able to pay the interest back and the company will go bankrupt. In that case, things will be pretty bad for shareholders as well. So leverage makes bad times worse. That makes bad times worse. That's why it's called leverage. Okay, so it magnifies everything. That makes good times better, bad times worse. That's why it's called leverage. So this ratio, as I said, it's about the capital structure. And I will show you a couple things and we will go fairly quickly over those. Long-term debt ratio is how much long-term you have compared to your total capitalization. Remember, long-term debt plus equity was total capitalization. What portion of your total capitalization is in the form of long-term debt? The second one is long-term debt equity ratio. So it tells you how much long-term debt you have compared to the equity you have. So this is just looking at the portions of long-term debt, basically. A more important measure is maybe the total debt ratio. It is total liabilities over total assets. Total liabilities is the same thing with debt, basically. Right? And what you do is, if you remember, this was the assets of the company. And you can portion it as debt and equity. Right? So this part is total liability. So total debt ratio is how much debt you have compared to this pie you have. One thing we don't have here, but it's very self-explanatory and it is more used actually, more commonly used, is debt to equity ratio. Debt to equity ratio, just guess the formula for debt to equity ratio. What's the formula? That's it, debt to equity ratio. So those two things are related. Here I have the total debt ratio, which is debt over assets, right? Or I can write it as debt over debt plus equity, right? Assets is the same thing with debt plus equity. So one thing to be careful about is you should know that these are linked to each other. So if I tell you total debt to equity ratio is 60%. Debt to equity ratio is 60%. What is total debt ratio? This is 60%. What is total debt ratio? How do I calculate it? It's not 40%. It can't. Huh? So if this is 60%, how can I write it? 60 over 100, right? So it basically says I have 60 debt and I have 100% equity. Ooh, well, let's start from, I mean, it's not going to change anything, but it will change the way I explain things. So let's just forget about this part. Sorry, take total debt ratio as 60%. Now it will be easier for you to understand. So this is 60%. If it is 60%, what is debt to equity ratio? So basically, if this is 60%, it means debt is 60, asset is 100, right? Okay, now it's better. So this is 60, and the total thing is 100. So how much is the equity? 40. So in this case, debt to equity ratio will be what? 60 over 40, which is 1.5, right? So they are related. I know it looks so easy, but in the exam you make mistakes. You do. Okay, so this is another thing. If I tell you debt ratio of a company is 30%, is it good or is it bad? Debt ratio is 30%. Debt ratio, this one. So you have 30% debts in compared to the total assets. Can you say anything? We don't know. I mean, you can say something, but can you say something that makes more sense, let's say? It depends on the industry. Like for manufacturing firms, 30% is nothing. But for some companies, if companies have lots of assets, for instance, they can have more debt. So if they're there, in that case, 30% is maybe lower than what their debt capacity should be. So again, to be able to say something good or bad, you need to have comparable values. So you don't know. I don't know. Okay, then we have times interest earned and cash coverage ratio. Times interest earned is earnings before interest and taxes over interest payments. So basically, if you remember, EBIT is the item just before the interest, right? EBIT minus interest. So this tells me what? This tells me whether my EBIT is enough to cover my interest payments, right? So if this number is 10, let's say, times interest earned ratio is 10, what does it mean? Exactly. I can pay my interest. I can pay 10 interest payments now. Okay, so my EBIT is 10 times more than what my interest payments is. And here we can do the calculation right away. So for this times interest earned ratio, we should calculate EBIT, which was sales minus cost of goods sold minus any other expenses, like selling, general and administrative expenses or store opening costs. It can change from one company to another. Then you deduct depreciation. So here you have EBIT. So in this case, for this company, EBIT is 3112. And then you're going to compare EBIT with the interest payment. And interest payment is 287. So for this company, EBIT is 11 times more than the interest payment, which is a good thing. It's high. It's a good thing. Whether it's optimal or not, I don't know. I need other figures. But it looks good. For cash coverage ratio, I'm adding depreciation back to EBIT and then compare it with the interest payment. Why am I doing this? Why am I adding depreciation back?
Because depreciation doesn't affect cash.
Exactly. Depreciation is a non-cash expense. So actually, in cash coverage ratio, you will have a better idea of whether you will have enough cash to pay interest. In this case, in EBIT, there's depreciation as well, but you're not paying out depreciation anyway. You have more cash than what EBIT shows. So this is a more, let's say, relaxed way of looking at the coverage, let's say. Okay, so these were leverage ratios. Any questions about leverage ratios? Then liquidity ratios. For liquidity, we have a couple. One is net working capital to total assets ratio. If you remember, net working capital was current assets minus current liabilities. Do you remember that? We spent a lot of time on it when we covered the cash and profit relationship, if I remember correctly. So it's current assets minus current liabilities. This is all about liquidity, whether the company will have enough cash. So net working capital will give me an idea about whether my short-term assets are enough to cover my short-term liabilities. So we are comparing net working capital with total assets. If net working capital is positive and high, it's a good thing because I can cover my short-term liabilities, basically. Another thing is I have current ratio. Current ratio is current assets over current liabilities. Let me write it here. It's current assets minus current liabilities. It should be higher than 1. Why? Your current assets should be able to cover your current liabilities, which translates into having positive net working capital, right? It should be greater than 1. So it means net working capital should be greater than 0. Because this is current assets minus current liabilities. Then we have quick ratio. I think this is also called asset ratio, if I remember correctly. So quick ratio is cash plus marketable securities plus receivables over current liabilities. So what is the difference between quick ratio and current ratio? We got rid of one thing. We got rid of inventories, right? We got rid of the inventories. What am I doing? I'm focusing on more liquid assets now, right? Inventories are the most illiquid ones. If you remember on the balance sheet, you start with the most liquid one and then go to the less liquid one. So it goes as cash, marketable securities, receivables, and inventory. So I got rid of the inventory. Then I have cash ratio. In this case, we're getting rid of receivables as well. So we are only focusing on the highly liquid items. So whether your cash, the most liquid thing, will be able to cover my current liability, short-term liabilities. In this case, I want to move to this question. I think these were from an old exam, short answer exam questions. Very simple one. This one's very simple. Maybe 5 points at most. Okay, let's read it together. A firm has 1.2 million in current assets, 1 million in current liabilities. So current assets is 2 million. Current liabilities is 1 million. Oh, sorry, 1.2. Okay, sorry. So first, what was the current ratio? Current ratio is over there. It's current assets over current liabilities, so it is equal to 1.2, right? This is old current ratio. Then this company uses 0.5 million of cash to pay off some of its accounts payable. In that case, what will happen to the current ratio? What happens to net working capital? So what happens is, what happens to your cash? Cash decreased by 0.5 million. And what happens is you pay your accounts payable, right? What was accounts payable? You bought something from a supplier on credits and you're paying it back, right? So when you pay it back, what will happen to your accounts payable? It will decrease. Perfect. So what will happen to your current ratio? Does it change? So what is my new current ratio? What is my new current assets? How am I going to calculate it? It was 1.2 before. Minus 0.5. Since cash decreased, you decrease your current assets. What happened to your current liabilities? It also decreased. It was 1 million. Since your accounts payable decreased, it also decreased. So it is 1.4, I think. So what happened? Your current ratio increased now. In the exam, we asked something like this without giving any numbers. And almost half of the students answered this incorrectly. So in the exam, if we ask you something like that without numbers, assign some numbers first and then make the calculation, do the calculation. Because, I mean, this is not confusing, right? But in the exam, believe me, half of the students got it wrong. So what happens to the net working capital was the second question. What happens to the net working capital? What was the net working capital before? It was, tell me.
4.2.
So it was 1.2 minus 1 million, right? Current assets minus current liabilities. What happened to my net working capital now? Did it change? No. Now it is 0.7 minus 0.5, so it's 0.2. Right? This is the new current assets. This is the new current liabilities. If you take the difference, it's 0.2. Any questions? Okay, the second one is not numerical. A firm uses cash to pay for additional inventories. So cash decreases, inventory increases. What will happen to the current ratio? Current ratio. What happens to current ratio? Is there a change in current liabilities? No. What happened? Cash decreased. You bought inventories. Inventory increased. So is there any change in current ratio? No. Cash decreased here. Inventory increased. They killed each other.
Inventory is not a current asset.
It is. Really? It is. Believe me. So nothing changed. But good thinking. You're answering the second part, I think. In the second part, it says, what will happen to the quick ratio? So here you have the quick ratio. What will happen to your quick ratio? It will decrease. You are spending your cash, but since inventory is not here in the formula, current quick ratio will decrease. Again, easy, right? Not that difficult. Write down the formulas. If it's not enough, make up some numbers, and you will be fine. Okay, any questions? Then we are moving into DuPont system. And we're going to use DuPont system to, what was the word for it? To identify return on assets and return on equity, but in a better way. I will start with return on assets. We already talked about return on assets. So for simplicity, I'm just taking interest here. So return on assets is net income plus interest over assets, right? If you remember, it was of operating income over assets. So I can write this like this. I can write it as sales over assets times operating income over sales. So in that case, those sales will kill each other, and you will end up with return on assets, right? But those two things are things we already know, actually. This part was asset turnover ratio. Remember, we talked about hotels, like Motel 6. We said it has high asset turnover, or fast food restaurants. The second part is something we also know. It is operating profit margin, actually. And we said operating profit margin is high for luxury products. Like Lamborghini, it's high. For Rolex, it's high. So for looking at return on assets, comparing companies, you can also have an idea of strategy of those companies. So which companies have higher asset turnover, which companies have high operating profit margin. Because unfortunately, there's a trade-off. You cannot have high asset turnover ratio and high profit margin at the same time. Because high asset turnover means maybe like high supply, let's say. When you have high supply, you cannot make lots of profits because the price of the product will decrease. And you can see it here as well. So this is a very nice graph for asset turnover and profit margin. As you can see, it doesn't go like this. So you can increase them both. No, it has a trade-off figure. So here you can see for companies, like utility companies, we talked about it before. Grocery stores. We talk about grocery stores, for instance. Grocery stores have very high asset turnover because they make the sale a lot. Okay. For utilities, if you remember, I said for utility energy companies, I said asset turnover is really low because they have high assets, fixed sales, but they make lots of profit on the sales. Okay? So as you can here, what else we have? Like it says hotels here. But as you can see, generally you have the energy companies with high profit margin. This doesn't differentiate luxury brands because that's why you cannot see it here. If we had the luxury brands, they would probably be here as well. So there's a trade-off between asset turnover and profit margin. And this is an example from your book. Now let's go into a more book example. Here I have a company, Admiral Motors. And Admiral Motors is buying its supplies from Diana Corporation. So Diana Corporation is a supplier for Admiral. And then Admiral says, okay, I'm going to buy Diana. Okay, let's see how things will go. So if you look at the sales of Admiral sales are $20. Its profit is 4. Assets is given as 40. So from here, asset turnover, what was asset turnover? Sales over assets, right? So it is sales over assets. 0.5 is the asset turnover for Admiral. For Diana, 8 is sales. Profit is 2. Assets is 20. So asset turnover is 8 over 20, sales over assets, which is 0.4. As you can see, Admiral has higher asset turnover compared to Diana. If you look at the profit margins, what is profit margin? It is basically profit over sales, right? So for Admiral, it is 4 over 20, 20%. For Diana, it is 2 over 8, which is 25%. And now you can see Diana has higher profit margin. So when you look at the merged company, when Admiral buys Diana, what happens is the sales is still fixed. Why? Because Admiral is the last seller, let's say. So we are only, and Diana was a supplier of the raw material. So sales are same, let's say. Profits, they merged because Diana was selling to Admiral. Okay, so we can add it to Admiral, a merged firm. Assets increase, of course, because of the merged firm. So if you calculate the asset turnover and profit margin, these are what we're going to see. So what happened here is, with this merger, of course, all the numbers are chosen so that return on assets are fixed here. Return on assets was asset turnover times the profit margin. So it's fixed for two companies. So when we merged, we were able to increase profit margin for the merged company, but the asset turnover decreased. So as you can see, there is a trade-off, unfortunately, for companies. So they cannot increase asset turnover ratio, also increase profit margin at the same time. I mean, I'm not saying they can never do that, but it's tough to do. So in the DuPont analysis, you can basically see where the return on assets come from. So the income generated for investors, how is it generated? You can see it in the DuPont analysis. So that was the first part of the DuPont analysis. The second part is about return on equity. So in the return on equity, it was net income over equity. And you can write return on equity with the second formula as well. Actually, the guy who came up with this, I think his name was DuPont. So that's where the number comes from. And these are the things we already know. So if you look at the mid part, this is asset turnover. This is operating profit margin. So together, they actually give you the return on asset. Then we have leverage ratio, assets over equity. It's something we also know. We did it here, right? We are just flipping it, but it tells us an idea about leverage, how much equity the company uses compared to assets. So this is about leverage. This part is also about leverage, because here I have the interest, and this is called debt burden. So if a company doesn't have any leverage, no debt, what is the relationship between return on equity and return on assets? There's no debt. How it's going to affect this part? If I don't have any debt, what is debt burden? Interest will be 0, so this will be 1. How about this part? If I don't have any debts, there's no debt, so all the assets will be in form of equity, right? So this will be also equal to. So if a company doesn't have any leverage, then return on equity is equal to return on assets. So let's go to this question. Okay. Bestmark Corporation's return on asset is equal to the industry average, but its return on equity exceeds the industry average. How is it possible? So I'm comparing my company with the industry. I have the same return on assets with the industry, but my return on equity is different. How is it possible? We just look at one item, so it should be related to that. It should be related to, It should be related to debt. Because of debt, probably. Because of my capital structure, my return on equity is different. And since we're on the same page, let's look at this. Then we're going to go back to our calculation. Bestmark Corporation has a profit margin below the industry average, but return on asset is equal to the industry average. How is it possible? What were the two items that affects return on assets? One was profit margin, the other one is asset turnover. If my profit margin is below the industry average, but my return on asset is same with the industry average, then what should happen to the asset turnover? It should be? It should be higher than the average. So if my asset turnover is higher than the industry, although my profit margin is below the industry, since I'm multiplying those two to find return on assets, I can have return on assets equal to the industry average. So this is what DuPont is enabling us, basically. So we can make those comparisons. Okay, if I have high leverage, would my return on equity higher than return on assets? High debt, lots of debt. 60%, 70% debt. How is it going to affect the relationship between return on equity and return on assets? Let's look at that, okay? Because we know that if there's no leverage, they should be equal to each other, right? That part was easy to understand, right? So if I have lots of debt, what's going to happen to this part? This part will be lower than 1, right? I will have interest payments. It will be lower than 1, okay? How about this part? If I have lots of leverage, this part will be higher or lower than 1? Higher than 1. So we don't know whether leverage will, because of leverage, I will have return on equity higher than return on assets or not. So I need to make all calculations, okay? So basically with return on equity, I will have an idea how my capital structure will affect my return, basically. Any questions about this? DuPont is an important thing, and we generally ask a DuPont question in the exams. Somewhere, midterm, final, somewhere, we ask DuPont questions. And also, sometimes we ask like calculation of financial ratios from the relationship of financial ratios. I remember the first year here, when I was here, we asked a question. We gave a couple of financial ratios, and then we asked a particular one. And when I was forming the answer key, my answer was like this long. And then I started grading the exams, and I saw like this girl, like she solved the question like with 3 lines. I was like, wow, how did she do it? She used DuPont analysis. So apparently we had, like she used the relationship between return on assets and asset turnover, and from there she found the operating profit margin. So my calculations were so long. So if you know DuPont, then it might help you in other questions as well. It's important. Okay, we are very good on time, so perfect. We have 10 minutes and we have a couple of things to cover. Again, I forgot the attendance. Okay, sustainable growth. For companies, actually for everyone, sustainability is a good thing. Okay? So whatever we are doing, if we are good at something, then we want to sustain it. Like you start exercising to lose weight, but once you lose weight, you continue with it because you want to sustain your weight, basically. The same with the growth. Companies want to have sustainable growth. Countries, my econ friend, they also want to have sustainable growth, right? So how are we going to calculate sustainable growth? So for that, we need to learn a couple more terminology. One is going back to our income statement. So now you understand why we're talking about income. We talked about income statement before because we need it in this chapter and then later as well. So when you calculate earnings, remember, part of the earnings can be paid to shareholders, and the remaining part is kept in the company as retained earnings, right? So do you remember that? In the income statement, we calculate the net income, and then we pay part of it to shareholders, and then we kept the other part, remaining part, in the company. The remaining part, addition to retained earnings, is the part that you can use for future investments, right? That money can be used for investments. The part that is paid out to shareholders is gone money. You paid it to your shareholders, it's gone. The one you kept it in the company, you can make investments. And remember, we said the value of companies come from two places. It comes from assets in place, the assets you already have. It also comes from future investments, your potential. For mature companies, what is the growth potential? Do they have lots of growth potential? No, they already expanded, right? For new startups, the growth potential is huge. And if you remember, we said mature companies pay more money to shareholders. The payout ratio is higher. But the startup companies, they don't pay cash to shareholders because they need the money for future investments. So the payout ratio is how much of your income is distributed to your shareholders as dividends. So this is the income you generate. This is the dividend payment you make to your shareholders. The remaining part is what is kept in the company, what is plowed back in the company. So plowback ratio is basically whatever is left over. So if your payout ratio is 60%, what is the plowback ratio? If you're paying out 60% of your income, what is the plowback ratio? 40%. Whatever is not paid out is plowed back in the company. So basically you can keep it, you can just change this one and you can say, okay, this is the income. Part of it is dividends. The other one is the retained earnings. So the part you paid out is 60%. If it is the case, the part you retained in the company will be 40%. So that was the first thing to know. The second one is I'm interested in growth in the company, which will translate into how much the equity value will grow, right? How much the equity value will grow. Why? Because the value of the company is the same thing with value of the equity. Going back to our original goal of a corporation thing, right? We're trying to increase the value of the shareholder, value of the company. So this will be found using this nice equation. How much money is plowed back in the company to be used in the future investments? And how much those investments will bring money, bring return to the company. So you are making the investments with that money, and you grow by those investments if you have good return on equity. Let's look at it with this example. Okay, let's go over it. I know you're very tired and probably hungry. Let's go over it step by step. This is the last one that last slide that you should really pay attention to. Then I have a couple of blah blah blahs. Then I will let you go. Okay, in 2009, Home Depot earned blah 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 and paid blah 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 in dividends. So this is the income. This is the dividends that is paid. So this is the income, and this is the dividend payment. So the payout ratio is dividend over income is how much? So what is the income? 2661. Dividend payment is 1525. So for payout ratio, what do I do? It's basically dividends over income, right? So the payout ratio will be 57%. That's where this number comes from. Plowback ratio is the remaining part, which is, I don't know, what, 1,000 and something. So the remaining is 43%. Then we say that it's given to us that return on equity of Home Depot is 15%. What is return on equity? It is net income over equity. So how much income is generated, how much return is regenerated for equity holders? It's 15%. So basically, if Home Depot reinvests 43% of its money, and with that money, if the company earns 15%, then the sustainable growth rate for this company, how much the equity will grow, will be equal to 6.5% a year. So the company's earnings will grow because of the company's earnings will grow because of two things. I lost the track of my thoughts. Very good. It's going to come from, okay, two things. One, the company is keeping the cash in the company for future investment. There is retained earnings. Also, from those retained earnings, the company generates return. You can think this as return on investment as well. How much return the company will provide on the investments it's going to make. So for this company, growth will be 6.5% a year. Can a company grow more than this? Yes. How? With leverage. Huh? Decreasing, yes, decreasing dividends, making more investments. At the same time, all this discussion ignores leverage and debts. So with more debt, the company can grow faster, actually. Why? Because we only said investments will be done with retained earnings, but that's not the only source of finance. The company can have external financing, like debt. So with more debt, you will have more money. And in that case, you can generate more return. Any questions on this? Okay. The last couple of things. Whenever I'm giving you a number, please try to compare it with another company, with historical numbers, with the industry, with the market, whatever. And you should be comfortable reading those numbers. One thing to take attention, to get your attention, if I can find it right away. Okay, so for those companies, return on Home Depot and Lowe's, return on assets are not very different. It's around 7%. But return on equities are completely different. One is 10%, one is 15%. Now we know that the differences between return on assets and return on equity can come from debt ratio. So you can look at the debt ratio, and it's indeed the case. Home Depot, which has high return on equity, has way higher leverage. So you should be careful about the sources of where the differences can come from. Transparency is important for companies, for sure. And also, different industries will have different ratios. That's why I'm saying you should compare companies with the industry itself. That's very important. You can have a look at the numbers. Different industries will have different ratios by nature. And the last thing is different companies with different credit ratings, of course, will have different ratios as well, or their different ratios will determine their different credit rating. Okay, I lost you already, so I'm going to stop. I know. On Friday, Kaan will solve a couple of questions. Where's the attendance sheet? Did you sign? All of you, herkes imzaladı mı? Okay, on Friday, Kaan will solve a couple of questions. You will have the quiz, and then we're going to start the new chapter.